So how did you get started on mortgages?
Yeah, so I ended up talking with my brother about this when I was in my mid-30s, and I was just kind of searching for a direction, and he was trying to help me sort of figure out what I could do that would make more money than music, because I felt like I was kind of getting burned out and kind of needed to earn more of an income. And he said, well, you really are good at finances. You really like money. You like learning about money. You like dealing with personal finance issues. And I said, yeah, that's correct. So he said, well, there seemed like there are two paths you could go. You could go mortgage or you could go financial planning. And I said, well, I feel more attuned to the mortgage side of things just because I feel like not everyone needs a financial planner. But when it comes to a mortgage, if you're going to buy a house, you have to use a mortgage broker, or you have to use some kind of conduit to gain access to that money.
Yeah.
Hey guys, welcome to the Realized Gains podcast. I'm Stephen Tran.
And I'm your co-host, Jordan Lee here. And we're just super excited to have my good friend and colleague, Ian Murdock, on the podcast today. You've been in the mortgage business for quite a while now. And maybe, Ian, do you want to tell us just like your background? I know you're not from the Portland area and like your story of how you got here.
Mm-hmm. Sure. So I grew up most of my life in the state of Utah. So lived in Salt Lake City most of my life and raised a daughter there, was married there, divorced there, and then eventually ended up in Portland. So my path to getting to mortgages is kind of a convoluted one because I went to school for music history and literature, and I played the trumpet, and I led 3 bands after college, and I taught trumpet lessons. And it was only when I turned 36 that I realized I need to do something that makes a little bit more money.
Wait a second. Are you saying trumpet lessons don't translate directly into sales?
That's right.
Well, he was operating his own business, right?
Sales,
teaching lessons.
Sales, in the sense of getting gigs and things like that. That translates into sales because, if you're going to perform for someone, you have to convince them that you're the best of the brass quintets that are out there or the best jazz ensemble for their wedding or whatever.
Yeah.
So there's a little bit of sales in that. And then there's a lot of wrangling of your musicians and getting them to be on time and learn the music and start on time and all of that.
So what's harder, is getting docs from clients or is it wrangling musicians?
Well, I would say the musician part because there's more of a deadline. There's a performance time. You have to be there on this particular time. With clients, it's like you have a period of 25 to 30 days, and usually in most contracts, and they can get you things or they can not get you things, and then you can escalate the level of your intensity of asking for things and say, if I don't have it now, then we're maybe not going to close on time.
Versus scrambling for a replacement at the last minute.
Yeah.
So how did you get started on mortgages then? Was there somebody that you knew in the industry or?
Yeah. So,
why mortgage?
Yeah. So I ended up talking with my brother about this when I was in my mid-30s, and I was just kind of searching for a direction, and he was trying to help me sort of figure out, what I could do that would make more money than music, because I felt like I was kind of getting burned out and kind of needed to earn more of an income. And so he said, well, you really are good at finances. You really like money. You like learning about money. You like dealing with personal finance issues. And I said, yeah, that's correct. And so he said, well, there seemed like there are two paths you could go. You could go mortgage or you could go financial planning. And I said, well, I feel more attuned to the mortgage side of things just because I feel like not everyone needs a financial planner. Not everyone, some people want to do it themselves, or some people just don't ever have enough money to use a financial advisor.
Yeah.
So but when it comes to a mortgage, if you're going to buy a house, you have to use a mortgage broker, or you have to use some kind of conduit to gain access to that money.
Yeah.
Did you have a house at the time, or have you gone through the process?
Yeah, I had been a homeowner by the time I got into the mortgage industry for about 10 years.
Okay.
Oh, wow.
So
you got a home early, huh?
I bought a home when I was 25.
As a musician, too.
As a musician.
Wow.
Well, it was my ex-wife's income.
Oh, okay.
That mostly helped us do that.
Yeah.
But at any rate, I had been, I was fluent in mortgage speak and understanding how to get a mortgage and what was involved. And so it didn't seem like too much of a leap to jump into mortgages. So my brother had his brother-in-law, so his wife's brother, was in mortgages. And so I just shadowed him for a day. I shadowed another loan officer who was introduced to me by a friend, shadowed her for a day, and just kind of got to thinking about it, interviewed with a few companies. And at the time, it was 2006.
Yeah. Mortgages were booming then.
Yeah, mortgages were booming. No one wanted to give you the time of day and
Right.
if you didn't know what you were doing.
Right.
They were just like, well, bring us your book of business and we'll see if we can find a desk for you. But no one was focused on educating me about how to do it, because as much as I knew about money, I didn't really know like the mechanics of how do I actually get someone a mortgage and go through that process. So I guess that was the real hurdle. And I did find a company that offered that kind of training. That was their focus, is that they were trying to train up loan officers to do things in the right way, just kind of in a more traditional way. And they were, it was amidst all this craziness.
Right. Oh, yeah.
But at the same time, they were saying, well, we're gonna try and take people through the process. And so I kind of became their star pupil and went through the process really well. Got into, understood things quite well. Other people who were in that program dropped off here and there, but I was kind of the one who stuck with it and was able to do it. And my manager at that time was named JR, and JR was kind of a wheeler dealer sort of mortgage guy, and he had this sort of loose philosophy, and I was more like, well, no, we need to do it this way, buy the book, we need to. And so I really didn't learn the business in the way that business was going on at the time, which was more loosey-goosey.
Right, totally.
I learned it in a
That's kind of lucky, actually.
Yeah,
I assume that most people in the industry then were not doing that and learning that.
Right, yeah, they were all just addicted to fast and easy money.
What is this called? Like ninja loans, or
Yeah.
Yeah, and you guys want to talk about that and describe what things were going on at that time?
Yeah, well, I mean, you can speak to it, Jordan, too.
I mean, I wasn't originating then.
But what was happening was that people could get mortgages without having any income or having any assets. Ninjas, no income, no assets, no job, or
Nice.
something in there.
Oh, you want to pay off your credit card too? Sure. Let's add that in.
Yeah. So, and you could borrow like 115 or 125% of the value of the house.
Crazy.
Like there were all these crazy programs that were being pitched at me, and I was like, well, how does that make sense? Exactly. And just I never really did any of those kind of easy money loans, because partially I didn't want to invest time in understanding them, because it felt like the landscape was shifting all the time. And I just felt like, well, if I can at least understand the Fannie Mae and Freddie Mac conventional mortgage, that's probably going to serve me better in the long run, or the FHA mortgage or the VA mortgage or USDA. Those kinds of things are going to be there. This fast and easy loan where you're stating your income is a certain amount and you're signing on the dotted line that it is a certain amount, whether it is or not, that didn't really, it just seemed like just a bit odd to me.
Yeah, I'm interested in hearing more on this, but before I forget, I really want to ask you what it was like to shadow somebody, because I'm imagining a loan officer, that someone wants to be a loan officer shadowing me for a day, and like, you know what I mean? It like, I feel like day to day that could be just a totally different thing. Were these folks like in call centers, or like what did that look like?
No, I mean,
that made you want to keep going forward, you know?
Yeah, and I guess it wasn't a whole full day of shadowing.
Yeah.
It was maybe like 2 or 3 hours. I was in his office, you know, and Casey is my brother's brother-in-law. And Casey just kind of showed me around and was introducing me to various people in the office. And this person does this, and that it's that. And then he showed me how to do a stated income loan. Okay, we're going to just state this person's income as a certain amount. And I was like, that seems weird, but okay. And then shadowing the other woman, Jennifer, shadowing her was really more like an interview. I was just kind of like, how do you get business, and what is the do you find that your clients are, you know, shopping you, or like how do you make sure that your clients feel like they're taken care of, and those kinds of things.
Right.
Yeah. So.
Okay, so let's go back to, you know, you're getting your training, you're going through your training.
Yeah.
You're the star pupil. Then the whole landscape must have changed dramatically, right?
Yeah. So 2007,
Did
2008.
your company stay in business?
Yeah, the company stayed in business quite well, and there were
probably because they were doing it the right way and training people to do the
right
loans.
For the most part, yeah. I mean, there were loan officers in that office who were, who tended to, lean toward the kind of easier loans as opposed to the more traditional. Mm-hmm. So, it kind of was all over the map. But at any rate, the company survived. It kept together, and I actually stayed with those same people for the full 10 years that I did mortgages in Utah.
Oh, wow.
So, it started out being Access Mortgage. We were a mortgage brokerage at that point, which is similar to what we are now.
Right.
But anyway, we were a mortgage brokerage selling loans to U.S. Bank or at the time there was a bank
That was
called,
back when there was a ton of banks did wholesale channels. Now it's like banks don't really do that much anymore.
Right, yeah. There was a bank called Taylor, Bean & Whitaker, and they were, they had some niche products. And so anyway, I was doing those kinds of things, doing a few renovation loans, 203K loans, things like that, but just doing a lot of standard stuff for friends, for people that realtors brought to me, for family sometimes.
Yeah, when you started, were you more with your sphere, or were you more with people that you were like cold calling? Was that a thing then, or was it more referral
I did a little
basis?
bit of cold calling, but not really too much. I mean, there was a point at which, in the early days, I felt kind of sheepish about contacting my family and friends, being like, hey, I'm doing mortgages now, and what is their incentive to even talk to me at that point? Because, like, what do you know about mortgages? You've been doing it for 6 months.
Right. Yeah.
So why should I trust you with this big decision of mine? And so I think some of that was more internal, more like I didn't feel comfortable, and so I didn't reach out as much as I could. And I feel like it would have been better had I reached out sooner.
Oh, yeah, especially because afterwards they're like, you talk to them like, oh, yeah, I just bought a home. And you're like, oh, yeah, I'm doing that. And then they're like, why didn't you tell me? I would have wanted to work with you.
Yeah. It was just kind of a level of kind of keeping myself away from them, feeling like they wouldn't trust me. Yep. But, just kind of a...
It's imposter syndrome in a sense?
In a way, yeah. Just kind of like, how would I, I was so good at being a musician, so what gives you any skill in doing this other thing that seems to most people to be completely different?
Right.
And so why should I trust you, the trumpet player who I used to know, to do my mortgage? And,
But it is interesting when you think about that, because, like, from the mindset of the consumer, right, like, what are they doing? They're going to some other person that they don't know at all.
Right.
And trusting them to do it, too. So it's like...
Yep.
But maybe not. Maybe they're going to some professional that they've been referred as well. So it's, I guess, you got to be able to see it from both sides.
Yeah. It's, I don't know. Anyway, that was kind of my entry into the business, was as a broker. And then about 4 years into my career, we were bought out or made a branch of a larger company that was an independent mortgage bank. And they did all of their own underwriting in-house. They funded their own loans, all of that kind of thing, called Citywide Home Loans. And so I was with Citywide basically until I left Utah and did loans in more of a retail type way, independent mortgage bank type way. Then when it got to that 10-year point and I was kind of not really happy living in Utah, and there was nothing really holding me there family-wise. My daughter lived already in the Seattle area and wasn't coming back to Utah anytime soon. And I had some family, I had friends in Utah, but I just felt like I needed a new perspective on life. And so that's why I chose Portland and interviewed with 3 companies here and ended up choosing Mortgage Trust after meeting with Michael. And at the time, Mortgage Trust was its own small independent mortgage bank.
Right.
And we did our own in-house underwriting.
Yeah, we had,
and
processing. 3 underwriters, I think, at the time, and maybe a company of like 50, a couple funders.
Yeah.
What's always, to me, impressed me about your business, Dean, is that you've maintained all of your clients and realtors, or maybe not all of them, but you still have a really strong business in Utah. Talk to us about how you've been able to kind of nurture and maintain that book of clients that's like nowhere near where you are. Yeah.
So that's a good point. And I met you first, when I came to Portland, and that's when we first met. One funny story I remember about you at that first best, there's this 100 best companies of Oregon, and we were sitting around, we were having drinks before dinner, and you ordered a Coors Light, and I was like, what? I'm in Portland here. Aren't you going to order an IPA? And he's like, I hate IPAs.
I guess I'd already hit peak IPA at that
point. That's a funny story I remember about you. But anyway, so keeping my business in Utah. So beginning in around 2010, I started this appreciation event for clients. And so this is while I was still living in Utah. And what I would do is rent out an entire movie theater at one of the Cineplexes and then show a Pixar movie.
Nice.
And Pixar movies at that time, and I think still, come out in late June around Father's Day. And so I would always rent it on a Saturday between the hours of 3 and 5 o'clock. And it would be in this kind of a mall space area in downtown Salt Lake City. And people would bring their families, and I would just give them free tickets. So free tickets for people, mostly, 4 per family was kind of my limit, but I would extend that to 6 or 7 because Utah has large family sizes. And so sometimes I would extend that, and, I'd fill a theater of, 500, 550 people.
Wow,
cool.
And those would be clients, they would be realtors, they would be people who had never done business with me. It was just kind of open to everyone who I knew. And I just put it out there as a sort of a goodwill gesture in a way. Just like, hey, come to this movie and see me, and you'll hear that I'm doing business, and you'll hear me talk at the beginning about how I do my business and how much I appreciate all of you for being my clients and blah, blah, blah. And then if later that turns out that you want to do a mortgage with me, great. Or if you've already done a mortgage with me and you feel that this is a way of me giving back to you and you appreciate that, then that's good too. So it was just kind of a goodwill gesture. I did that probably for 10 years, even after I moved here. Through
in Utah still?
Yeah, I would fly back to Utah.
Yeah. Okay.
And in 17, 18, 19, I flew back to Utah to do that. And then 2020 was the first year that I didn't do it because of COVID.
Yeah.
And then I really haven't gotten back into the swing of doing it again. But that's one of the things that has kept me connected to those people in Utah.
Yeah, yeah.
And I've just, made it clear to people, hey, I'm moving, but I don't want to lose our relationship.
Right.
And you can still reach me, and I'll be just as available as before, just a phone call away or just an email away. And people have been okay with that.
I guess that's the nice thing about being in your business is you could literally be anywhere and still manage the state that you were in.
Exactly. Yeah,
right.
A lot different than real estate.
Homes, we don't have
a lot different from being a realtor.
The hard part,
yeah. You have to be physically in places, and that's one thing I like about being a mortgage broker is that I have that virtual sort of job where it's in the ether. It's about people's money. It's about technology to a large extent, and it's more conceptual and virtual, as opposed to being physical like your job is.
Yes, most of the time.
So yeah, that's that.
And don't you also like write a newsletter or a blog or something like that?
Yeah. So in 2017, when I moved here, I started writing a bi-weekly newsletter where I'll keep in touch with clients, and basically it's just me. Maybe the first paragraph is about something I've been doing, a hike I've taken or a trip I've been on. And I'll just kind of give a little personal detail, and then I'll go into something that talks about how to get a mortgage on a condo and why that's different from other mortgages, and how to, maybe I talk about a recipe that I like, or maybe I talk about a book that I've just read, and maybe it's money related, maybe it's not, and it's just kind of, it's kind of all over the map. It's somewhat financially oriented, but it's more just like these are the things I'm interested in, and I have an understanding of these things that are extraneous to mortgages, and so I have a well-rounded financial understanding of things, and so I think the message that I'm trying to get across there is, you can ask me stuff, and maybe I'll know stuff, and maybe that'll help you.
I like it. It. Simple.
Yeah. So that's another way that people feel connected with me, because even if I'll call someone and I haven't spoken with them for 5 years, they'll be like, "Oh yeah, I get your newsletter. I like that," because they feel like I've been talking to them.
Right.
Even if I haven't, obviously, and they just haven't been talking to me, and so in some sense, it makes my calls to them a little more welcome.
Totally.
Because they feel like I've already been reaching out.
Okay. Well, can you talk about just moving to Portland and kind of building your book of business here? Because I'm sure you could have sustained your style of living with your business back in Utah. But how about here? Like, were you trying to actively build business outside of the newsletter?
Yeah. So I already knew a realtor who lived here when I moved here. She introduced me to a couple of others. And sort of organically, my business has grown to a handful of realtors in Portland. And a lot of referrals from those realtors, and sort of built it up to the point where maybe 50% of my business is the Northwest area, and 50% is maybe Utah. So it kind of varies from month to month as to which is more prevalent, but so moving to Portland, first, ever since I've been in Portland, I've been with Michael's group of people. And so in that way, I feel like I've been a very loyal employee, loyal to my people in Utah for 10 years and loyal to Michael for 9 years. And that has come with Michael making decisions to move our company to different organizations, like Cherry Creek Mortgage was our, after being an independent mortgage bank, we became a part of Cherry Creek, which was another independent mortgage bank, but a larger one based in Colorado. And then after Cherry Creek, we joined with Fairway, which is another independent mortgage bank. And we did that for 3-4 years.
Right.
And then beginning almost 3 years now ago, we became a mortgage brokerage again, and are now selling our loans to various investors depending on their guidelines and whatnot. Yep. And I feel like it gives us a lot more freedom.
Yeah.
Than we had at Fairway.
Yeah, it's full circle for you. I'm glad I didn't start as a broker. I think it would have been harder to learn at the beginning as a broker.
Yeah.
Because the process is a little bit more like fragmented and like less clear. But I think I love the flexibility of the broker process.
Well, do you guys want to just give like an overview of lender versus broker and kind of that process?
Yeah. Well, so being an independent mortgage banker means that the underwriting is taken care of within Fairway or Citywide or Cherry Creek. They will do the underwriting process, and you'll be working with a certain set of closers and funders who work within the company as well. So the whole process of the mortgage is held within the same company.
Right.
And you're always dealing with the same underwriters. You come to know what certain underwriters will expect. You come to dread getting this underwriter and be happy about getting this underwriter.
Yeah.
And so, I mean, there are some advantages of at least consistency in knowing what to expect, I suppose, within an independent mortgage bank. But when you're talking about being a broker, more of that is on you as the loan officer to select a lender who you might have previously had good experience with, or other colleagues of yours have had good experience with, and therefore you're comfortable trusting this mortgage with that lender.
I mean, certainly for me, the my percentage of volume that is like conventional or FHA versus like other things like HELOCs and commercial loans or DSCR loans, bank statement loans. Like it's the percentage of that is just conventional in FHA has gone down significantly compared to like the other stuff that I do.
Yeah, so you've branched out more into DSCR.
I mean, it's not like the massive part of my business, but it's for sure like all the other things. Like it used to be very rarely would I do anything other than a conventional or government loan.
That's interesting because my business has not really changed in that regard. I've not really, I mean, I don't think I've done a DSCR loan, period. And I occasionally will do a HELOC, but generally people will go to other banks to get HELOCs. And so
I don't know why people want to do HELOCs.
That's good. That's good for you. That's good that you've been able to
what about
out.
reverse-wise? Have you done more reverses since we've switched over?
So reverse mortgages, I guess I did my first one in 2009, I think it was.
Okay.
And then have done a handful.
So pretty early on. And back in 2009, reverse mortgages, were they similar to what they are now? Or
They were similar, yeah. I mean, I think one of the protections that changed in, I think it was 2013 or 14, was this requirement that the non-borrowing spouse, if someone is married, then their spouse has to be on the reverse mortgage and considered as a part of the reverse mortgage, even if they're not of age.
Take their income, their debt, and everything.
Mostly it's their age.
And to account their age. So the
the age of borrowers within a reverse mortgage matters a lot because it dictates how much you'll be able to obtain in the mortgage itself.
Ian, can you just explain what a reverse mortgage is?
We better start from
Can you explain what a reverse mortgage is?
Yeah, so in its most simple form, it's just another type of mortgage. It's just another piece of debt that is on your house. With a regular forward mortgage, you have a piece of debt, usually 80% of the value of your house, or maybe 95%, depending on what your down payment is. And that piece of debt sits on the home, and you work to pay it off over the period of 30 years. And you pay it off very slowly at first because the principal is going down very slowly. And then toward the end, in years 25, 30, you begin paying it off much more quickly.
Right.
Okay, and so you eventually end at that ending 30-year period, you end up owning your house free and clear.
Right.
With a reverse mortgage, for people over 62, that's the threshold. You have to be 62 or greater to get one. At least one member of the couple needs to be that. With a reverse, you think of it differently because you still have a piece of debt that's sitting on the house, but that piece of debt is dictated by your age, the interest rates at the time and whatnot, and it's going to be a lot lower than 80%. It's going to be maybe 30, 40% of the value of the house. And that piece of debt will sit there, and instead of declining over time, it's going to increase over time.
Okay.
So that 30% the next year might become 31%. And then 32%. But at the same time as the balance of the reverse mortgage is growing, the value of that person's house is also growing,
right,
just as it would in a regular mortgage.
Yep.
Right? So that distance between the debt and the value remains relatively stable in most reverse mortgage scenarios.
Depending on the market, of course.
Depending on the market. But, if you look at, say, a 4% appreciation rate, and you look at the fact that the mortgage balance might be growing at anywhere from 4 to 6% a year, there maintains a fairly stable amount of equity throughout the time that you have when you look at reverse mortgage projections.
So the idea that you're going to come to, you might die or whatever, that there's going to be no equity left isn't necessarily the
Generally,
case.
that doesn't happen until you reach past age 100.
Oh, really?
Yeah.
Okay. So in most reverse scenarios, unless you live over 100, which would be a great problem to have, there's still going to be equity left when it goes
for the most part. In most projections. I mean, there's no way of saying for sure because interest rates will change over time.
Right.
That's another difference between regular and reverse mortgages. Is regular mortgages have generally fixed rates. For that full 30-year period.
Right.
With reverse mortgages, you have adjustable rates. They're adjusting every month. And it's based upon what the constant maturity treasury index is doing at any given time. And so that is, you can think of it as sort of similar to the 10-year treasury.
Right.
And as that treasury note goes up and down over time, with eighth of a percent increments, that will change a person's reverse mortgage interest rate. Right. And so someone getting a reverse mortgage right now might be facing, say, a 6.5 or 6.25% floating interest rate. But that rate, if rates continue to come down, could be 5% next year. And they would be happy about that because then their mortgage is not growing as quickly.
Right.
So anyway, does that help you to understand kind of what a reverse mortgage is in general?
It does explain how it works, but can you explain why someone would want to get a reverse mortgage?
Yeah. So one of the reasons that someone would want to get a reverse mortgage is to eliminate their existing mortgage.
Right.
So let's say you're 62 or greater and you have a mortgage of $100,000 sitting on your house. You project that you're going to be paying on that mortgage for another 10 years at the cost of maybe $1,000 a month. And you say, I wish I weren't having to make this payment anymore. And then we look at it and say, well, your house is worth $500,000. So you could get a reverse mortgage in that situation, maybe eliminate that $100,000 payment. And also, because maybe based on your age, you can get $200,000 in the reverse, which would be 40% of $500,000. Maybe you can get a reverse mortgage for that $200,000 amount, wipe out the first of $100,000, and then have that extra $100,000 that is available for you to tap into.
So that's like a line of credit.
Right, that's a line of credit. And for all of that, you exist with no payments on the mortgage.
Right.
You still have to pay taxes and insurance, but you exist in a place that eliminates that $1,000 that you were paying to that $100,000 mortgage, and now you're free of that debt. So that's why someone might want to improve their budget by $1,000 to take out their reverse, and they also might want to have access to that line of credit. And the trade-off would just be that their mortgage balance is not going to decline over time anymore.
Yeah.
And you could set it up. You could get a line of credit, and you could also set it up as kind of an annuity, right, where you get a monthly payment coming every month.
Right. Yeah, you could do that too. So that $100,000 could be parceled out. You could parcel it out over a certain term that says maybe $100,000 would last, let's say, at $500 a month. That's $6,000 a year. So maybe you could, with the growth of that line of credit, maybe that could grow. That could last you for, say, 20 years. You could have a 20-year term of getting that money. Because we take into account that the $100,000 is not static; it's going to potentially grow over time. So
that's the other interesting thing about reverse mortgage that a lot of people don't know is that initial line of credit that you receive, it grows at the same rate that your mortgage is growing at. Correct.
Yeah. So
it is truly a reverse mortgage in that sense.
And so that's why I say maybe that $500 a month, $6,000 a year, could last for, say, 20 years, which would be $120,000. And you might say, well, that's more than 100. Well, that's because the 100 would theoretically be growing at some rate that would allow for that $500 a month. Anyway, but you could also set it up such that you're getting a 10-year payment, TENURE, 10-year payment for the rest of your life. And that payment is going to be in some cases, it can be greater than the term payment you might be setting yourself up for. So you can look at both options.
Mm-hmm. And all those calculations are better the older that you are, right?
Yeah. So the older you are, the closer you are to the theoretical point of death, because we look at the actuarial tables and we say, well, how much are you projected to live? If you're age 62, you're projected to live for maybe 25 years by the actuarial tables. Whereas if you're 82, maybe you're only projected to live another 10 years.
Mm-hmm. So you'll have more access to your equity based on your age.
Yeah. So maybe it's only 6 or 7 years if you're 82. But anyway, the actuarial tables will get greater as you get older.
Now, is this like life insurance where they come to your house and they prick your arm and they give you like a rate?
No, they don't do that. But it's based on actuarial tables, much like life insurance.
Okay, but you don't have to go through the test at all, right?
No, you're not being tested for how healthy you are or any of that.
Okay. They don't ask if you smoke or anything?
No. There's no question about that. But what was I saying about the so someone who's older would have access to more money than they would if they were younger. And so the older you are, the more you have access to, just because you're closer to that theoretical point of death, even though you may be certainly a very healthy 82-year-old, and maybe you're going to live to 102.
Right.
But at any rate, you get more money available at that point. And the amount of money you're given is based upon the prevailing interest rate and your age. And then that will result in a principal limit factor.
Got it.
So the factors that I've talked about are 30% or 40%. But it'll end up being something like 41.6% or some number like that that's calculated from a table.
So talk to us. I mean, okay, so I think a lot of people, when they think about reverse mortgages, you think about that refinance portion.
Yeah.
But for realtors, I think what often they don't understand is that you can also use it to purchase a home too.
That's correct.
And my understanding is that you do a decent amount of reverse mortgages for purchase.
Yes. Yeah, reverse mortgages for purchase are kind of the underappreciated thing in real estate. I feel like realtors don't know about it and don't recognize how powerful it can be for their business.
So, I mean, when you mentioned about reverse mortgages, you said that there's like basically a line of credit, and that's the what they can use for their down payment. Is that generally the game plan?
Well, no, it works differently than that. So if you, in a purchase situation, ostensibly you have a lump of cash, either.
Let's do a situation. So let's say you're downsizing.
Right. Yeah. So let's say that you have a $500,000 house that doesn't suit you anymore. It's got too many stairs, or it's needs some adjustments for you as you age. So it's no longer really suitable, but you feel like you're sitting in this $500,000 house, and that if you own it free and clear, let's say, and you feel like as a borrower, as a homeowner, you feel like, well, my options are simply that I could buy another $500,000 house, or probably less once I pay the realtor fees to deal with that. So maybe I can buy a $450,000 house or something. And what am I going to find out there that's $450,000 that I actually want to live in?
That's a single level and suits my needs,
Right, and that is in a neighborhood, without also getting into a neighborhood that maybe I don't want to live in anymore. So that's where the reverse mortgage comes in handy, because you can say, well, yes, you're going to realize $450,000 from the sale. You can take that chunk of money and use that as your down payment. So if you're able to access, say, 30% in a reverse mortgage, and you say that you want to buy, say, what would it be? Let's say, let's say a $650,000 house, and you say that you want to put 30% down or 70% down there. So 70% of 650 is going to be $430. Let's say what would be 455.
Okay, sounds about right.
455,000, something like that. And so then you're going to say, well, that gives me, maybe with some extra savings, you have enough to add to that $450 that you got from selling your house to be able to make that down payment. And that includes the closing costs as well. So let's say that all of the closing costs are included. Now you've upgraded from a $600,000 or $500,000 home into a $650,000 purchase.
Right. So it
that you
increases
never really
your
thought was
purchasing
possible.
power. But and then also, because originally you're going to buy it with cash, right? So you don't have a payment. Again, just like cash, you won't have a monthly payment on this house. And sometimes these folks cannot you could do the same, right, with a forward mortgage. You could just use this proceeds and buy a house with a forward mortgage. But then you're going to have a mortgage payment, and you have to be able to qualify for that mortgage payment.
Yes.
So in some circumstances, you're not able to qualify for conventional mortgage for various reasons.
Right.
And in a reverse mortgage, you don't have to qualify
Yeah,
for
the
as much, right?
the financial qualifications are much lower. So, so in that case of getting a $195,000 reverse mortgage for that $650,000 purchase, where you're putting $455 down, in that situation, you don't have to qualify for any payment on the $195.
Right.
Nothing at all. You simply have to be able to prove that you're able to afford the taxes, the insurance, maintenance on the home, which is calculated at 14 cents per square foot.
Mm-hmm.
So let's say a $3,000 or 3,000 square foot home, that's going to be $280.
Okay.
Or $420
Okay.
for that one. So $420 there,
Plus taxes.
plus
and
let's say your
insurance.
taxes are $500 a month. And let's say your insurance is $200 a month. There's $7. So you're talking maybe $11.50, something like that. And then you also have to factor in the ability to pay for residual income.
Right.
And that differs from area of the country. But here in Oregon, for a couple, that's going to be about $1,000.
Yep.
And so then you're sitting at a position of needing to have, say, $2,200 of income.
Right. Versus typically you need like $6,000 to $8,000 of income for qualifying on a conventional level.
Right. And HOA dues, if they were there, they would also be added to that, or any debts that you have would be added to that as far as the financial qualification. But that's a much less onerous hurdle to clear. In terms of qualifying, you can easily clear that with, say, a $3,000 a month Social Security, or $2,000 Social Security plus a $1,000 pension, or
Right.
any number of things that are pretty reasonable for most
Totally.
retirees.
Totally.
So,
Still rolling. Henry was trying to call.
Oh, no worries. So it sounds like we've got a couple of great options, right? So you can use the reverse mortgage to, get rid of your current mortgage, access your equity. You can also use it to purchase or increase your purchasing power on a home.
yes.
What else do people use reverse mortgages for that, like, we wouldn't normally, like, the general consumer doesn't think about?
Well, I think that one other area that gets left behind a lot is the idea of someone who says to themselves, well, I have $2 million sitting in the stock market. I'm just going to live off that for the rest of my life. And I have this paid off home.
Mm-hmm.
Why do I care about getting a reverse mortgage?
Right. What do I need that for? I
Yeah.
don't have a mortgage payment.
Right. So they would argue, well, it doesn't make any sense. Whereas if you look at, let's say that person did take out a reverse mortgage.
Mm-hmm.
And let's say that they have a $800,000 home, and that they can take out, say, 30% of that when they're 62.
Okay.
So then they can take out a $240,000 line of credit, essentially, on their home.
Okay.
So that $240,000 is going to grow over time at the
Right.
rate of interest.
Mm-hmm.
So if they take it out at age 62 and they let it grow, and then maybe by age 72, maybe it's at $350,000 in value.
Mm-hmm.
Okay. Let's say that at the same time they turn 72, there's a severe downturn in all markets. Let's say that the housing market, the bottom falls out of it, and his value, the value of that consumer's home is now, instead of being worth $800,000, it's now worth $500,000. Let's say that something weird happens,
Yep.
but he still has the ability to access that $350,000.
It doesn't
Even
get
if-
the line doesn't get called on.
Right. No one is doing a reappraisal of his home to say he can't access that money. He can still take that $350,000 if he wants to. And let's say that simultaneously with the housing market slump, there's also a stock market slump.
Right. So his 2 million went down to 1 or 1.5.
1.5 or something.
Like that. Yeah.
And then he says to himself, well, gosh, this is the worst time for me to be taking out of my stocks
Right.
because the stocks are down.
Yeah.
So you don't want to sell low, you want to sell high.
Right.
So so he's sitting there thinking, gosh, what am I going to do? And then he remembers, oh, good thing I took out this $350,000 reverse mortgage. I'll just use that as my buffer asset. I'll use that to get through this period of time. And maybe it takes 3 years for the market to recover. Well, he's probably got 3 years of his monthly expenses dealt with there, because that's maybe like $120,000 a year that he could draw from that line of credit.
Right.
Through that 3-year period, gets himself through that. Then his stocks recover to 2 million, or maybe they go to 2.5. And then he's like, good thing I didn't sell when I was down, because now I have this money that grew again. And then if he chooses, he could say, well, I'm going to take some of that 2.5 million that now my stocks are worth, pay off this reverse mortgage down to zero again. And then I'm still sitting at 2.15 million in my assets. So in a sense, he's no worse off, but he's gotten through that 3-year period.
Right. So he's kind of mitigate the sequence of risk return, or whatever they
sequence
call
of return risk,
in financial planning, where you have access to other means where you don't just have to pull. I mean, they might still have to take their minimum required withdrawals or whatever, but from IRAs
minimum
and distributions from their IRAs or whatever. But you can limit if you're pulling from a big asset and spending on it every year.
And so from a theoretical point of view, this makes total sense, right? If we game it out and we look at it, in logic. But the fact is that most borrowers don't think that way. They're not thinking, well, maybe there will be something that I need this for 10 years from now. Let me take it out now. It works in theory, but to get someone to actually buy into that theory and take action on it, because they're going to be spending money to get the reverse mortgage at the time. I mean, they're going to be basically putting those closing costs into their line of credit as their first expense.
It's much more expensive than a HELOC.
Yeah, can we talk about the expense of getting a reverse mortgage?
Yeah, so the expense of getting a regular mortgage is generally between 2 and 3% of the purchase price. The expense of getting a reverse mortgage is usually between 3 and 4% of the value of the home. So it's more expensive. And the main thing that makes it more expensive is that you've got a 2% upfront mortgage insurance premium that goes straight to FHA. And
which, with an FHA loan, you've got a 1.75% on a normal forward mortgage on your loan amount. So it's not like a ridiculous premium, but it's also based on the value of the home.
The value of the home. So you're sitting in loan, you're getting that $800,000 home considered as the value, and you're saying to yourself that you're going to pay $16,000 just for the mortgage insurance premium to get the mortgage. And so that can be a big hurdle to clear in your mind. But if you recognize that that mortgage insurance actually does protect you, for one thing, it makes the mortgage product available in the first place, because without the mortgage insurance, no lender would offer a reverse mortgage. And so you've got that, but then you've also got this protection against potentially being upside down in your home. So that client who has the $800,000 home and it's now worth $500,000 and it's got the $350,000. Well, let's fast forward 20 years, and that $350,000 maybe has grown to $650,000 in terms of what he owes on. Let's say he's tapped out that $350,000 at the time because he did the strategy I mentioned, and now he owes $650,000 because of the time that's passed between then and the growth of that mortgage. Well, now he owes $150,000 more, so it's 20 years in the future, and let's say his home is still worth $500,000. Market's still dead, so he's upside down by $150,000.
Right. Yeah.
But he doesn't have to make that whole. If he chooses to move at that point, all he has to do is give the bank the home, give the keys to the bank and say, here's the home. Take the $650,000 of debt that I have, and you deal with it.
Right, because normally when you have a home and your mortgage balance is significantly higher than the sales price, then you have to
then it's a short sale
do
situation.
A short sale or do some kind of foreclosure.
Yeah. Whereas with this, you're protected from the beginning from that kind of thing happening. Now we're talking about a lot of what if scenarios here, and this is why it's hard for people to pull the trigger on a reverse mortgage, because they feel like, well, that's probably not going to happen to me. I'm probably never going to die.
Right.
No,
And after home values have gone down, then you can't do that, right?
Right. Or, it's the same thing that keeps people from drawing up a will.
Yep.
Or taking out life insurance.
Yep.
Or, exercising every day. These things that people are like, well, that's a future problem. I'm not going to deal with that.
Right.
Whereas if you take ownership of it, the literature says, in gaming it out in various Monte Carlo simulations, you can see that taking out a reverse mortgage as early as possible in retirement and letting it grow allows you to have more assets at the end of your life. And that's true whether you have a line of credit balance that's open or whether you're just paying off an existing mortgage. In both of those situations, you end up with more assets at the end of your life. Like, we can take the example of my parents. My mom and stepdad, they live in California in a condo, and I helped them get a reverse mortgage 7 years ago. And they were buying their house. They had the ability to put 50% down on this $660,000 condo. So they put the $330,000 down, and they were gaming out ideas of, well, should we get a regular mortgage or should we get a reverse mortgage?
Right.
And so I said, well, if you get a regular mortgage, it's going to be $2,200 a month.
For another 30
that's
years.
going to be the payment that you'll make for the next 30 years. And they're sitting there at ages 70 and 80, and that seems like a lot to pay for the next 30 years. Yeah. Or you could save that $2,200 and get a reverse. And so I helped them get the reverse, and they started out with a $330,000 balance. It's now grown to about $440,000, $450,000, something like that. And their value of their condo has also grown from $660,000 to more like $800,000. Okay, so they've maintained most of the equity that they put into it. It's not really grown much. But how much would it have grown had they made that $330,000 payment? It probably would have only declined to $290,000, $280,000, something like that.
Gone down a little bit,
Yeah, so that's a fairly small difference for 7 years of no $2,200 a month payments, which has allowed them to travel more, to be more generous to family, and they've just had such an easier life. And I also help them manage their assets as well, their retirement and investment assets. And those are still sitting at the same place that they were. They've never had to touch those assets. They've remained at that same level. And that's been a real, had they had to make that $2,200 payment, I'm almost certain that they would have had to draw from those assets to make those payments. Or they'd say, well, we're going to take this trip. It's going to take $20,000. Maybe we'll just take that out of our assets instead. Whereas with the reverse, they've been, they're saving so much that they can just pay for that trip out of their regular income.
Typically your mortgage payment is your biggest expense. So getting rid of that is just really nice.
Yeah. So let's see. So those are three instances. We've got the elimination of the regular mortgage. We've got the opening of the line of credit, and we've got the purchase situation. The situation that many people, the situation that's kind of hard for people to stomach is the idea that they might have to bring money to close. They might owe 50% of the value of their house in their mortgage.
It's like bringing money to close in a refinance.
Yeah.
Nobody wants to do that.
Yeah, and people look at that and they say, well, it's going to take me forever. I've got one set of clients who've come to me 3 different times. They're disappointed with their value that their appraiser gave their home, and I don't have any control over that. But they're faced with anywhere from $40,000 to $70,000 that they would have to have brought to the table to get their reverse mortgage.
Right.
And over the last 3-4 years, they've decided not to do that 3 different times.
Right.
And I've said to them in the past, I've said, well, you're making a $2,800 payment every month. So if we just add that up over time, just think of it as prepaying all of those payments. Because I guess to get into the nitty-gritty of what I'm saying is if you owe 50% of the value of your house and you're only able to access 40% in a reverse mortgage, then you have to bring that extra 10% to the table to close. Because you can't get the reverse mortgage at 50%. You can only get it at 40.
Yeah.
Does that make sense?
Yeah, no, it does. Can you tell us how you're finding these clients, just in general, like how you're building this clientele of people who are needing reverse mortgages?
Well, some of it is just telling this story to realtors and helping them to see the value of this kind of a program.
Is that still your biggest referral source for
I would say,
realtors?
I wouldn't say it's the biggest. I would say that it's one significant source. But yeah, it's like explaining this to realtors and kind of having the light bulb go off in their minds as to, oh, I've got this or that client who's been telling me that they want to move, but they don't think they can. And I don't think they can either. Yeah. But then they realize, well, this is actually a solution.
Because they're thinking things in a traditional way. They're looking at the interest rates and the payments they'll have to make. And Right. Or they're looking at the cash option. They're saying, well, if we're going to buy with cash, then all we can liquidate from this house in cash is this much, and that's going to buy us X home in the future, and that's not a good home. Yeah, or like I said, liquidate some of their stocks on top of that too, and that's like the assets for their retirement, which
that's a hard sell for them to buy to upgrade their home style to buy with cash, just to take out of their assets. But if they could just use the equity that they have in their current home, and turn it around and afford a more expensive home using the reverse, that's the real ticket that makes a lot of sense for people.
Okay, great. And then, let's just say, as a realtor, I get pinged by, lenders and brokers all the time about giving business. What is your key to winning over a realtor?
I think it would just be the communication style that I use and the fact that I'm available for questions and that I'll answer, lots of things that they might not understand about whether it's about a reverse mortgage or a regular mortgage. I'll, be in communication. That I think the communication is the biggest selling point that I have for my own business, and the fact that I, know what I'm talking about and that I'm knowledgeable about products and able to sort of translate, able to educate the client. Like a first-time home buyer, it takes a certain level of hand-holding, a certain level of, helping them to see the whole process and understand how it goes. Other clients won't need that. They won't, they'll be fine without it. And so it's kind of being able to read the level of education necessary for certain clients and to meet them at their appropriate place. I just feel like realtors look to me for that kind of expertise, and it's worked out.
And would you say reverse mortgages is a big part of your business? Like
I'm trying to make it more and more a big part of my business. I just recorded a series of 20 different videos that I've put up on YouTube, and kind of explaining these various use cases for the reverse mortgage. And I'd say another source of my reverse mortgage business is just some past clients who will contact me and say, I want to do a refinance. And I say, well, you're 65, so have you thought about this option? And I have one story about a client who I said that to 5 years ago, and he said, oh, no, don't talk to me about that. Because no one really wants to talk about a reverse mortgage. Nobody wants a reverse mortgage, but everyone wants what a reverse mortgage can do for you.
Right. Yep.
Because it's a great product in terms of its way of creating options for you. I plan to get one myself when I turn 62. So, and I'm not in a category of a person who needs a reverse mortgage. Who's like, I'm not desperate for it, but I can see the value of some of the things that we've talked about here. And so some of it's those past clients, but that client from 5 years ago who said, no, he just recently contacted me again, and I said that he's going through a divorce, and I said, well, this might make a good solution for your situation, and he's now thinking about it. He's still now in the stage where he's trying to convince his soon-to-be ex-wife to go along with it, and it's just kind of I feel like people in many cases look at the reverse mortgage as kind of the last thing that they're ever going to do with their money.
Yeah.
But it is a fluid kind of mortgage because, my parents who are living in their condo, now 80 and 90 years old, they could sell.
Right.
They could sell that condo and move away and find something else. And they've talked about moving to Oregon. I said, well, all right, you realize $400,000 or $350,000 from the sale. So yeah, take that and let's get you another reverse mortgage in Oregon where prices are cheaper, and you can do that. And so you're not stuck when you get a reverse mortgage, but people feel like
you got to live in your house till you die if you do it.
They feel like it's a death sentence in some ways.
Yeah, and then your family's going to be responsible for it afterwards, which is totally untrue.
Yeah. Let's address that myth too, because there's this myth that your kids are screwed by a reverse mortgage. Well, if we look at my situation with my parents, am I screwed? Not really.
Which is the most common situation, by the way.
Yeah, am I looking at their home and saying, gosh, geez, I can't wait until they die? No, I'm not saying that. That's not my thought process. I'm happy that they're living a better life.
Right. And you're not having to financially support them, I feel
like. Exactly. I mean, can you imagine if they were making this payment and they couldn't make other payments and then they needed help? No, I don't want to do that. And so they're basically, they deserve to live off that money.
Right. Yeah. That's what they've paid and saved for all their life.
Exactly. And so so I feel like that's some of what gets touted in the media is, this person, this child who inherited the home didn't realize that granddad had a reverse mortgage, and she's now very upset because granddad had always told her that she would be inheriting the home. Well, maybe granddad forgot to mention the fact that he has a reverse mortgage, but it's been the way that granddad's been able to stay in his home for the last 20 or 30 years.
Right.
And so the granddaughter looking at that and saying, I feel cheated by the reverse mortgage, is not recognizing the fact that that was granddad's money.
Yep.
Yeah.
And granddad decided to do a certain thing, and still, if you sold that home, you could still realize maybe $200,000, but maybe not the $600,000 of value that is in the home. But that's because granddad had a better life.
Yeah, no,
and so granddaughter is upset. She complains to the media. The media writes a story about it. Here's why reverse mortgages suck.
Yep.
And it's like, no, they don't suck. They're just, there's miscommunication there.
Any inheritance is a good inheritance. I mean, that's how I feel.
Yeah.
I'm not expecting that. So
yeah.
Well, let's talk actually about the mechanics of that too, though. So let's say you do live a long time.
Yeah.
You're underwater on the mortgage. The reverse mortgage has grown larger than the value of the house.
Yeah.
What happens to your heirs at that point?
Yeah, good point. So your heirs are not on the hook for that, just like you're not on the hook for that as a borrower. FHA takes care of that overage. So let's say
that's what you pay the insurance premium for.
Yeah, exactly. So let's say you've got a house that's worth $1 million, but the reverse mortgage, because granddad lived to 100 years old, let's say that the value of the reverse mortgage is $1.1 million.
Okay.
Because he's had it for 35 years or something,
okay.
35 years.
So we've got 100,000 of excess.
Yeah, so 100,000 of excess. So if the heirs, let's say the granddaughter, wants to keep that home in the family, she's actually got an advantage in that situation of being able to buy it for 95% of the appraised value.
Okay.
So the granddaughter could come in and buy the home for $950,000, even though what's owing is $1.1 million.
So you're saying that the home appraises for $1 million, and the kids then get the right of first refusal. They can purchase the home for a premium under what it won't before it goes to market.
Yeah, they can buy it for 95% of its value.
And they don't have to pay that extra $100,000 that was outstanding there.
Well, $150,000 in that case.
Or $150,000, yeah.
Yeah.
The bank just swallows that loss with their insurance premium.
Exactly.
So if the heirs choose not to buy, then it's just sold by the bank? Is that how it works?
Yeah, if the heirs choose not to buy, then the bank just takes over the home and facilitates a sale.
Okay.
And then it's the bank's and FHA's problem at that point.
Okay, gotcha.
So it, that's a situation where, the heirs aren't out. They're not going to be on the hook for anything. In most cases, though,
and if they wanted to buy it before they died, it would be worse. It wouldn't be as good, right? Because the loan would be bigger.
Right. So if they wanted to buy it, you'd have to
loan.
satisfy the loan in order to buy it.
Okay, interesting.
So it does work better for them to have that 95% ability.
And how long does that period last for them to purchase?
I don't know that I'm not sure of the time limit. I would say it's probably in the range of 3 to 6 months that they would have.
Because I was thinking, like, if you're dealing with someone passing,
right.
You're trying to do a purchase.
There's got to be some kind of time limit. I don't know exactly what that is, but I would be surprised if it's less than 6 months.
Okay.
Yeah, there's some notification by law that you have to do, and probably an extension period. I think I remember that you could request.
There's got to be something in there.
Gotcha.
Yeah.
Okay. And then, as a realtor, if I'm working with a client who is going into like a reverse mortgage process to purchase a home, what do I need to know with helping them in their purchase process? Because usually I just get a pre-approval letter and I just run forward. Is there anything different?
Yeah, like when he's presenting the offer to a listing agent, for example, that might not be super familiar with a reverse product.
It's funny. I just was texting a realtor about this very issue just before I came in here, and she was asking, do I need to write anything different for this loan as far as drawing up the contract? And I said, no, it's just a standard purchase contract, except that the down payment is much larger than you would normally see.
Okay.
And so, and you also need to mark that it's an FHA loan.
They're still going to get an FHA appraisal.
Yeah.
Okay.
It's an FHA loan. And that's one of the things that we should also touch on is the idea that FHA is really concerned that value be what it is. So in some cases, when you're doing, usually it takes place in refinances, not so much in purchases, but in some cases, you have to do 2 appraisals for FHA. Because FHA looks at the first one and says, well, we're not really trusting the value for whatever reason. They go through their system to figure that out. And if they don't trust the value.
There's like a review of the appraisal, and then based on that review, they could condition for a second
It's
appraisal.
kind of an automated review, though. So the result comes back fairly quickly. It's not like a person is actually looking at it. It's some kind of automated view. And then if FHA calls for another appraisal, well, the client has to pay for another appraisal.
Oh.
And does that happen commonly on purchases?
No, not commonly on purchases. It probably happens maybe 25% of the time.
And that's usually at the higher values, is it? Or
sometimes.
It can be anytime?
Yeah, it really happens all over the place.
Okay.
And part of it is, the reason for it is that FHA really cares that value be accurate.
Yeah.
Because if it's not accurate.
Will they use the lower of the two?
Yes.
Oh, okay.
Yeah, so clients are often not happy about that.
Because sometimes appraisals can be vastly different than their values.
Yeah, so that's one of the things you have to state up front with your clients is you've got to understand that this thing is going to possibly require 2 appraisals, and you might have to pay for both of them.
Okay, so higher upfront costs. And then for the realtor side, we'd really just see like a pre-approval with like a high down FHA. That's pretty much all we would basically present.
Yeah, exactly. Yeah, and then I think I didn't quite get into the rest of the closing costs. So 2% for that upfront mortgage premium, and then you've got a set of other closing costs that are kind of similar to a forward mortgage, like title, appraisal, underwriting fees, things like that. That comprises maybe $3,000 to $4,000 in kind of more or less fixed costs. And then you've got the origination fee, which may or may not be there depending on where they select their interest rate. The higher they select their interest rate, the less need there is for the loan officer to charge an origination fee. But the lower they want their interest rate to be, the more likely it is that you'll have an origination fee.
Right.
And so that origination fee is as high as $6,000. So in that situation of the $800,000 reverse mortgage, we're talking 16 plus, let's say, 4 plus 6, so we're talking maybe $26,000 of closing costs.
Okay. Well, in this market where, like houses are sitting, like, we could utilize a lot more of the closing costs in this situation.
Yeah.
Yeah, which would be pretty good.
Yeah. And it's not, in my opinion, it's very similar price to a forward FHA mortgage. Slightly more expensive.
They're pretty expensive already.
Yeah.
Yeah.
You just don't normally feel it in an FHA forward purchase, because it's tagged onto the loan amount versus, impacting your down payment.
Right. Yeah. Right. Yeah, so I think that pretty much covers most of the issues. We talked about the myth of the heirs, and there are the myths of the bank owns your house, and the idea. Well, I mean, when you get a regular mortgage, the bank owns part of your house too.
They're gone title.
Yeah, the bank owns 80% of your house or 95% of your house. With a reverse mortgage, they owe a lot less of your house, 30 or 40%, and that amount rises over time. But at any point in time, you can say, I want to sell this house. There's a payoff for that mortgage. The payoff gets satisfied. The rest is yours as the borrower.
Yeah, I mean, like I said, for me, I don't know anything about reverse mortgages. Now I do. But yeah, I've always seen them in a sense of like what the media tells me. They're predatory. They're going after seniors.
Right. Yeah, going after seniors.
Well, it's only available to seniors.
Yeah, but I mean, it presupposes that seniors are somehow stupid and they don't really understand what they're getting, and that they're, so I mean, a lot of education does go into getting a reverse mortgage, and there's a lot of, there's potential complexity to it, depending on your level of financial savvy. But at the base level, it's simply another type of mortgage.
Yeah.
Right.
And it has a payoff at various points. That balance is going to rise over time, so that payoff is going to increase. The payoff over here on the forward side is going to decrease over time. So.
Yeah, and you have to go through counseling too to get one of these mortgages through an independent counselor.
Exactly.
Whereas with a forward mortgage, sometimes you have to take a first-time homebuyer class to get a special rate or something like that. But generally speaking, you don't have to go through, because it's actually like live counseling with a phone call with somebody.
Phone call with someone, usually 30, 40 minutes, something like that, and you're talking through some things. And if I've done my job correctly, you don't really have any questions for the counselor. The counselor's just like, oh, well, seems like you already know everything.
Right.
And that's fine. Go on your merry way and have a reverse mortgage. And so I would say that the time frame in getting a reverse mortgage is probably at least twice to three times as long in terms of people's willingness to actually get it. When it comes to the purchase and actually getting it, one would hope that by the time they're selling their home, I've already done the work that I've needed to do to convince them that this is the right method for them to use to get this home.
Yeah.
And so the time that it takes from start to finish on a purchase is no different than a regular mortgage. You
can still close in 30 days.
Yeah, you can still close in less than 30 days if you want. And so what I'm saying about the length of time it takes is more about the reverse mortgage and someone getting mentally ready to do it and mentally convincing themselves that, yes, this is the right idea.
And sometimes convincing their family.
Yeah. You sometimes have to get children involved or financial advisors involved or siblings involved. It can run the gamut. And there are many times that I've talked to a borrower and it makes perfect sense. It really works for their situation. It'll give them more income or better cash flow in their situation. And then we'll be totally on board. And then they'll say, oh, well, my son talked to me about it and he doesn't like them. And I'm like, well, could we talk to your son? Could we talk to your son and find out why he doesn't like them? And yeah, anyway, it can be a long, if you're talking about a sales process for how to sell a reverse mortgage, which is never really how I think about it. But if you're talking about it from that perspective, the process is a lot longer than getting a regular mortgage. I mean, we know that getting a refinance can sometimes be drawn out by people feeling, kind of a lack of
urgency or just trying to time the market. Yeah.
Yeah. So refinances can sometimes take longer for us than regular mortgages just because people need to feel like they want to do it now.
Right. Yep.
And with the reverse, it's even worse because people think, oh, well, this is the last of these kinds of transactions that I'm ever going to do, even though it is likely not. But they think to themselves, they have certain conceptions about how they think about these kinds of decisions, estate planning or drawing up a will or getting life insurance or deciding to buy an annuity. They think all of these things are similar to getting a reverse mortgage and that they all have tied in with them this idea of death. And people don't want to face that.
Yep. True.
Is there any benefit of getting it exactly at 62 or waiting? Because I know you mentioned the actuarial tables and obviously if you're going later, then you have a shorter time frame to death. Like, do you have any opinions on getting it like as soon as you're eligible versus waiting?
Yeah, I mean, as I mentioned, the percentage, that PLF, principal limit factor, is more generous when interest rates are lower. So a 62-year-old in a period of low interest rates, say 5 years ago, might have gotten a much higher PLF.
Yeah.
Whereas a 62-year-old now is getting a much reduced PLF. So 5 years ago, maybe that 62-year-old got 40% of their home value available. And now they get 30.
Yeah.
And so, that can be a consideration, but
that's hard to time the market.
It's hard to time the market that way.
Yeah.
But in general, if, the research has shown that if someone gets a reverse mortgage at age 62, as early as they can, and then they just keep it and let it grow over time, that growth is really going to be the thing that wins the day.
It's the miracle of compound interest, right?
Yeah, the growth of that line of credit availability. It's not that you actually have money in there growing. It's the availability of the money is growing for you. And so that 240 that you might start out with in a reverse mortgage growing to 300 and 350 and 400 and whatnot, while all of this time you're not using it, it doesn't cost you anything to let it sit there. You've paid an upfront fee to get the reverse mortgage, but in the long run, the research shows that getting it at age 62 and letting it do its thing and living your life and using your assets as you need and then using it potentially as a buffer asset when it may be necessary, but that strategy gives you the greatest rate of success in retirement, a successfully funded retirement.
Yeah. No, that makes sense. Rather than digging into, like you mentioned, your other assets.
Well, and exactly, and also not just a successfully funded retirement, but also your heirs are, in the end, going to be happy with you because there will be more money for them to inherit.
Right.
Because you will have needed less money over your lifetime.
Yeah.
Yeah, and
or you'll have needed to draw from less of those assets over your lifetime.
And who knows what the scenarios can assume. Like what your current mortgage payment is or when your current amortization of your forward mortgage might be at that time, right? But obviously, if you're 62 and you just in the last 5-10 years gotten a mortgage, right? If you refinance then, it's going to be different than if you're refinancing at the end of your forward mortgage, right? Mm-hmm. So there's the added benefit of just not having your mortgage payment for the rest of that time too.
Yeah. Exactly. Yeah. So every situation is going to be a little bit different, and we're going to have to kind of game out the numbers and see how it works for you. But I would say that in most cases where I look at reverse mortgages for people, and if they qualify and everything adds up, then it generally makes sense to do it and to pull the trigger, even though that can come with its own reservations, and people can have their own hang-ups about that.
Yeah, they can have their feelings about not knowing where the market's going in 10 years, and whether there's a huge crash or things just continue to grow, which can affect how they decide in their situation.
Yeah.
Well, we have some final questions. If someone is interested in getting into the mortgage world, what kind of advice would you give them?
That's a good question. No. I would say, just do some reading. Understand how. Maybe read a book like Mortgages 101 or something like that to just understand how the mortgage process works and understand whether this might be the thing for you, whether you might fit into that role. Do you enjoy doing technical paperwork and organizing things and is your temperament what it needs to be for being a mortgage professional? And then do you enjoy kind of educating people about finances? Does that ring a bell for you? And if all of that's true, then getting into the mortgage business, I would say find a company that has some kind of some resources and materials or people within the company who can help you sort of get up to speed. Because I feel like a lot of my learning within the mortgage business was done through the training program that my company had, but then also the most important things were just like, I've got this problem, this thing that's happening with this mortgage. I wonder if anyone else has had this problem before. And so I go to Rick's office or I go to Nolan's office and I say, well, have you guys dealt with this? It seems like you had a situation like this that you were talking about recently. And he's like, oh, yeah, you got to go do this thing and then this thing. And then this lender will do it for you, but this lender won't. Or, it's like that kind of institutional knowledge of, finding a group of people to work with who will be willing to answer your questions and kind of help you learn the ropes, because there's going to be a lot of just on the job, this wacky thing just fell in my lap. How do I deal with it?
Yep, totally. Yeah, Ian's talked me through at least 2, if not 3, reverse mortgages. So thank you for that.
Yeah.
Great. And then if people were trying to get a hold of you, what would be the best way for them to find you?
Well, they can look at my website, which is ian-murdock.com, and that's ian-murdock.com. And they can look there. I'm on YouTube under Murdock Mortgage. If you go to YouTube /@Murdock Mortgage, I'm there. I'd say that those are 2 good ways. You can also call me, 801-322-3311.
Okay.
Yeah.
No, that's great.
Yeah.
Thanks so much.
Well,
Ian.
thank you for having me on this podcast, and I hope this has been informative.
Yeah, it's been great.
Yeah.
Thank you.
Thanks.